Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we have one of our most prolific and returning guests, Marvin Lowe. Marvin is a senior global market strategist at State Street Global Markets. He and his team use State Street's proprietary institutional behavior, risk, and inflation metrics to look at monitor some of the markets and do some forecasting. He's a graduate of NYU, both undergrad and MBA, and so I guess Martin's on this podcast about every quarter, so I guess it's appropriate for me to say welcome back, Martin.
It's great to be back. Thanks for having me once again, Rob.
Yeah, so you all are looking at a pretty big data bank all the time. What's the data you track telling you now? You see any red flashing lights that we're not aware of?
Yeah, I mean, for sure. So, one of the things I think that separates kind of how we look at the market is that we do have a series of indicators, which I think is proprietary and provides us with some pretty interesting insight into what the investor is doing. So we kind of look at it from kind of a hard data perspective that's alternative to what's out there. We've had an incredible rally over the last couple of months, and certainly, as we record this, there's been a little bit of pressure on that rally over the last few days. But if you kind of look at where equities have gone, if you look at where credit spreads have gone, it would seem as if everyone's participating in that rally. And to a certain degree, our real money data set is showing that overall, kind of that institutional investor is less defensive. But by saying less defensive, I'm also saying that they're not necessarily embracing risk to the degree that you would potentially see in asset valuations. So we've got this really high level indicator of investor behavior. We call it our behavioral risk scorecard. It's our attempt to put a single number on whether or not this real money data set is risk seeking and or more defensive in nature. We can get a score as high as plus 22, a score as low as minus 22 based on these relationships. And right now it's smack dab at zero. So when
Okay.
we were, yeah, exactly. So when we were kind of looking at that data before the market got a little frothy, let's say October and November, and we were talking about a Fed pivot, it was deeply negative. So it's made its way back to neutral. So that's certainly a positive. But in terms of like really embracing risk, I think when we look across some of the subcomponents that drive that number, real money again has removed its underweight, but it's doing so in a very gingerly, methodical way, and not really adding risk as aggressively as maybe some of the asset values would lead one to believe.
Okay, so what does that look like in terms of actual choices? Does that mean they're taking cash they've accumulated and putting it into certain issues, or is it rebalancing, or what does it look like?
Yeah, for sure. So that indicator I was talking about, the behavioral risk scorecard, there are kind of these five subsectors. One of them looks more at the equity market. One of them looks at fixed income. We've got an FX component, a commodity component, and then we do have that cash asset allocation component. So more recently, we have seen some of that cash move out of that asset allocation bucket. So that is a kind of a pro risk move, and it's been moving into the equity market again somewhat gingerly, not necessarily a screaming signal, but for sure, equities seem to be the place of choice for some of this risk taking. Interestingly, on the other side of it, some of the FX, which really looks at credit, looks at emerging markets, those indicators are negative. So they are a bit defensive on potentially how aggressive maybe credit spreads have moved or how aggressively some of the EM trade has really evolved over the course of the last few months. And then just kind of rounding everything out from an FX perspective, which a risk-taking type of signal would be buying a lot more emerging markets, buying a lot more commodity-driven FX. That's pretty neutral, and commodities themselves are pretty neutral. So kind of the soft landing type of environment that the market really grabbed hold of was something that was missing within our data, or at least not as aggressively portrayed kind of within this real money data set.
Okay, and when you say moving into equities, is that global equities,
Yeah,
developed markets, or
generally we do look at it from a global perspective. So, we would look at more cyclical buying than defensive buying. We would look at potentially more high beta stock buying than lower beta stock buying. So again, there are a number of these kind of cross asset relationships that we kind of plug in there. But overall, out of a score as large as +5 for that For that asset group, it's at a +3. So, it's a pretty encouraging sign for those that think there's more room on the equity rally side of things.
Let's talk about emerging markets because they've been returns been low or negative for some time. So, what are people looking at in that? Are they trying to choose individual good companies that have maybe fallen unfairly, or where do you think they're looking in there?
Yeah, I mean, so really thinking about emerging markets and I think where most of at least the institutional money interest is, fixed income's a very, very large part of that discussion. So there's a carry trade associated with that. There is a relative yield perspective that goes along with that. And if we kind of look at how last year evolved, given the aggressive increase in Fed rate expectations as well as rate expectations around the rest of the developed market, it was probably a challenge for emerging markets. That carry trade works best in an environment where you've got more clarity when it comes to the developed markets, a bit more stability. And I would suspect that if we finally get to a point where we're comfortable with rate cuts coming across the developed markets, kind of rather than this discussion that we're going through now, is it going to happen in March? Is it going to happen in June? Is it going to happen in
Yeah.
September? Once we get there and there's more clarity around it, it probably creates an environment where it's easier for that emerging market asset class to do better. And then from that perspective, we are seeing those interest rate differentials play in that thought process. So LATAM is a perfect example of that. There is some political discussion now when it comes to LATAM, particularly around the elections, kind of thinking about which countries might be a bit more isolated if in fact we have an aggressive anti-trade type of environment that builds. So it is picking those kind of winners and losers, but you do have still this broader uncertainty in the developed markets, which is keeping probably folks from embracing emerging markets as aggressively as they might, given some of the interest rate differentials that are out there.
Okay, well, it's impossible to talk about rates with it talking about inflation. And here, as we're recording this on Valentine's Day, February 14th, 2024, we had CPI yesterday. So, what are you all seeing in that?
Yeah, I mean, certainly it was a shock when we kind of look at how the markets behave. They weren't prepared for it. I would say that our view had been that the last mile was going to be the hardest, and I'm hoping that I actually probably used that line in a prior podcast because we really felt that the market had gotten ahead of itself and thinking that everything was going to just disinflate magically to kind of this 2% level. So we weren't as surprised by it, kind of, looking a little bit more deeply in it. I think the components that everyone's talking about is the super core, which is wage driven. It's this housing number, which is certainly driven by the strange position that the overall housing market is right now with rates spiking, but overall activity collapsing and keeping housing values high. I think all of that is still going to create an environment where it's not clear whether or not we kind of get to that 2% as aggressively as maybe policymakers had hoped. What I would say is what our data is potentially showing, and another one of those indicators that we find unique and somewhat proprietary to State Street is our inflation data. So it's around price stats. That data looks at online prices. It is a bit more goods focused because it's just easier to get online data on goods rather than services.
Right,
That
right.
data had been really showing deflationary trends all through the better part of the end of 2023.
Okay.
At this point, it's showing some stability and a little bit of an uptick. So, it's a couple of weeks of data looking at late January into early February, but it is raising at least a question in our mind as to whether or not the goods deflation, which has been so important for CPI, which has been so important for PCE, might be running its course. So, I'm going to be looking at that data closely because if services inflation isn't moving as aggressively as policymakers had hoped, and goods deflation has really kind of at least kept the overall number, whether it's overall core, overall headline, somewhat within reason. If it loses that deflationary goods tailwind, if you will, it does make for an even more challenging kind of discussion going into the second quarter of this year.
Right. No, and I'm glad you mentioned that because in a lot of these conversations seem to get sort of hung up on wages and housing. And wages have gone one direction, and housing really kind of gone one direction. So it's great to dig into the details there and find out more about where that is. So, and this kind of leads me to the next logical question, which is, given all that, how do you think the U.S. consumer is doing? Because boy, does this economy rely on them. So,
Yeah, for sure, for sure. And the consumer, just looking at the official data, whether it's retail sales, whether it's, surprises to retail sales, whether it's around consumer confidence, they do seem engaged in the economy. The jobs market is a key facet of that for sure. I think liquidity, and I know you and I have had conversations about the amount of liquidity based on the Fed's balance sheet and/or, really the availability of credit, particularly consumer credit card credit is supporting that view. When we kind of look at our data, at least in terms of what that institutional investor is buying in terms of equity sectors, we do see a lot of interest in kind of those consumer categories. So there is a follow through in the view that at least for that institutional investor that's putting money to work in the equity markets, the consumer sectors still are something that's attractive to them. I would point one other thing that's interesting though, kind of in terms of a gingerly approach to risk, is that while we see strong consumer flows, which is kind of how we describe our custodial data, we also see strong flows into utilities, which is the exact
oh,
opposite. So
okay.
there is a hedge around that for sure. Utilities have been able to increase their dividends a bit more than the broader market. Utilities do offer kind of that safety hedge, if you will. So there's almost like a barbell approach to kind of approaching risk, which if you put them together, looks more neutral overall, which is how the upper level number is placing itself at the moment.
That's fascinating. Have you looked at, well, for instance, compared public and private utilities in that? Are they going across the board, or is there a difference there?
Our data focuses on the public side of things. So, that's kind of where I could speak to it. I do know, just looking at the private markets as a proxy for risk and for liquidity, that certainly private pools of credit are, amazing at this point.
Yeah.
There's so many private pools being created, ultimately looking for probably a more distressed type of environment, but it does speak, for at least for me, to the amount of liquidity that's in the system, which kind of gets the Fed's QT, and whether or not this discussion that they're either going to slow or stop QT within the next couple of quarters is a potential policy mistake that might be able to go back to an inflation discussion if they keep too much liquidity in the system.
Yeah, fascinating. That is really interesting because this is one of those areas that they say everything begins and ends on the margins.
Yeah,
That's that's an interesting margin to look at for sure.
for sure, for sure.
Okay, so it's exceptionally interesting to talk about the U.S. consumer for a lot of reasons, but one of the things that I'm always a little bit curious about is it seems like a lot of the pandemic support should have rolled off by now. Are you all looking at that?
Yeah, for sure, for sure. And it has rolled off for a lot of people. Kind of broadly, having said that, we still believe that there is pandemic savings that are out there. It's probably more focused at this point in the upper middle class to those that have the highest income streams. Certainly has been supported by strength in the securities markets, which again are focused on those folks that are at the upper echelons from an income perspective.
Right, because they own stocks
Because
generally.
they own
So
stocks,
yeah.
yeah, generally speaking, and it's been a heck of a run ultimately. But we do think that from a real wage perspective, so you do have wage growth that's still above levels that we saw before the pandemic, and you've got inflation which is now below it. So every single month, you do have consumers, the average consumer, that's finding itself with more money than it can spend, and it is spending that. One really interesting thing that I think might be playing into this is this housing discussion. So the ultimately the unaffordability of housing, and it's a terrible situation for folks that are looking for houses, where if they've given up hope that they're going to find a house, whether it's because of interest rates where they are, whether it's because housing values themselves have gone up so much, they've also given up saving for those houses from a down payment perspective.
Oh,
And
okay.
I think you do have a cohort, particularly of younger families, which are looking at potentially renting for the rest of their life based on kind of the economics that they're seeing. And if they're going down that route, yeah,
Right,
there's
whatever they had saved for their down payment, they can just spend now.
yeah.
Yeah. Yeah.
I do think there is kind of that revenge spending that's associated with that.
Interesting. If they do choose to do some things, they're going to be facing some higher expenses for travel because
Yeah.
that is no joke. So,
It is no joke. It doesn't seem to really be going in our favor, those of us who would like to take trips. That was one of the core services numbers that was higher than folks expected in this January report around kind of those airline fares. Somewhat offset by a used car. So I guess if you can't fly, maybe buy a used car a little bit cheaper than you did the month before and drive to your location. But again, it does show kind of those pockets of strength in the economy, which has always been, in our view, one of the challenges in saying that we're going to glide to this, guaranteed 2% inflation number by the, second, third quarter of this year. And it is proving to be a bumpier, stickier course of travel than maybe what the market assumed even just a month ago.
yeah, yeah. Well, it's unfortunately over history, it's never been a straight line. So I guess it's historically accurate. Well, thank you, Marvin, for being here again. I am going to link to the podcast that we did last time where you talked about the deleveraging, which you referenced here, because I think some people might want to listen to that again because that's still pretty timely. And yeah, and thanks again for being here. And we'll see you another quarter.
Thank you so much for having me as always.
All right, and thank you to everyone listening to this podcast. Until next time, I am Rob Rowan, your host of Compound Insights.